Hey everyone, and welcome to today's show on Wealth Strategy Secrets. Today we're joined by Christoper Nelson. Christoper is an experienced technology executive, having gone through 2 successful IPOs, real estate investor, author, and the principal and co-founder of Wealthward Capital. Wealthward Capital is a real estate investment firm with a diverse portfolio of over 3,000 multifamily units, mobile home parks, and ATMs. Christoper shows technology employees how to achieve financial independence through education and creating passive income portfolios. He is currently editing his book, From No Dough to IPO. Christoper, welcome to the show, man.
Hey, thanks so much, Dave. Excited to be here.
Yeah, awesome to have you on the show. I guess for folks who aren't really familiar with your background, let's start out with your journey. Talk to us about the tech side. We have a ton. Our audience is full of entrepreneurs, full of people in the tech industry. So you can throw out as many acronyms as you like.
Great, I can dig into the acronyms. Yeah. Well, I saw technology as a great way when I was in school. I fell in love with tech. And I just thought, like, this is the future. I want to work in this industry that I see a lot of growth, a lot of, possibility and potential. Getting out of school and graduating in 2001, it's interesting, is that was a downturn. Like all of a sudden the bubble burst, weren't a lot of jobs. And so it was interesting. I was thinking about this the other day, as we've talked recently about a lot of people getting laid off. There were literally companies that were sending me offers that these companies just had imploded and gone away, and it was a very crazy time. I chose to go to work for Accenture, which is a large technology consulting firm, I wanted to focus on building skills and building the ability to execute. While I saw the vision and the opportunity to work for equity, I wanted to actually build my skill set first. And that ended up being the right move down the road, because I built what I call career capital, which is a set of, experience and results that then when it came time to start working for startups, I was able to trade that for good portions of equity.
Nice.
Yeah.
And so what domain were you in on the tech side? I mean, were you doing business consulting, or where were you specifically?
I was on a systems, so I was in the systems integration side. So yeah, okay. So I worked doing a lot of financial systems implementations, and then I worked at CRM. And what really accelerated my career was in 2004, I had the opportunity at Accenture to start the Salesforce.com practice, which was a brand new delivery model, right? The software as a service that's now ubiquitous today. Back then it was this client server model. And I was really frustrated by a lot of those implementations because we spent so much time on the basics and the fundamentals. When did we get an opportunity to really accelerate the business? I saw software as a service as that ability to, okay, you actually have a lot of the core features out of the box. Now we can iterate quickly to deliver high value for the business. And that's where really I spent, a lot of time between, 2004 and 2009 is really delivering that to clients globally.
Got it. And what firms were you with on the IPO side? And tell us a little bit about that journey going, through an IPO.
Well, yeah, I think
version.
I think the biggest value, is always in our failures. And so when I left Accenture and I was really at the height of this career, like I was, a global expert technical architect for Salesforce.com in 2008. And we were unicorns, like very rare at that point. So I was literally being flown around the globe, and I found myself in Tokyo, very burnt out. And I didn't realize that I was burnt out. And I think it's important for people to realize that, like, as we talk about health and wealth strategies, is when you're burnt out, you're not going to be making the best decisions. And so when it took that decision to invest my time and my talent and choose my first startup, I made a very emotional decision. And instead of moving towards something that I was focused on, I was running away from fear. And so the first company that I chose for a technical, for a startup company turned out to be an abject failure. Within a year, I found myself the company wasn't advancing. I was working for a bad boss, et cetera. But it was really out of that came a lot of learning. And this is the mindset shift that I think has really helped me accelerate a wealth strategy, which is I need to invest my time. Like I was a, W-2 employee, had this tremendous career capital of, this Salesforce expertise early days. I had traded it to a company where then I wasn't getting any value from it. So the second time I went to a company called Splunk. Most people know. And so I joined Splunk in 2011, was employee 417. And that was what got me to my first IPO. So I then joined a company called Splunk, and I worked there for 5 years. And then I joined a company called Yext, pre-IPO as well. They ended up going IPO. I chose wisely, but it ended up not being the right fit for myself and my family. So I actually decided to leave that company before the IPO and go to a company here in Austin, Texas called ForcePoint. And it was a private equity company. And I wanted to see if I could do have the same results in private equity as I could in venture capital backed companies. And it did not IPO. And then I went to, in 2020, I joined a company called GitLab, and we IPO'd in October of 2021.
Nice.
Yeah.
Nice. No, you're absolutely right. I mean, there's so much to be said for the value in the learning experience, right?
Yes.
Just, as entrepreneurs, we're going to make mistakes. You're always going to make them, but it's all about accepting those and learning from them. Right. So you can, build upon that. So many people are afraid to actually take action because they might make a mistake.
That's true. And then I also think that, one of the most powerful things that I did, in the midst of that abject failure in nursing this ulcer, as I went and I had to look at the decisions that led to that, right? And that can be a painful and aggravating process, is looking into failure and distilling out the lessons. But the reality is that after action review, or that discovery, whatever you want to call it, is a powerful solve. I don't know if I said that right, but it's powerful medicine that will actually heal that wound and then give you these lessons that now are etched in your brain or etched on your soul that you will carry with you, and you realize you'll make different decisions. And some of those were, I needed to understand and be clear of my value. And then I needed to have a due diligence process, just like you do for, real estate in the companies that I go to work for. And that was something that was able to lead me to Splunk, and then ultimately now to GitLab, to get those 2 successful IPOs.
Yeah, no, that's really insightful, because conventional wisdom out there teaches us to, what do they teach you, right? To focus on your fixing your weaknesses.
Yeah.
Right. And trying to be a jack of all trades and knowing all of these things. Right. But in the real world, it's actually really about doubling down on your strengths. And in order to do that, you have great wisdom around what your strengths are. Where do you play best? And then how can you capitalize on those?
That's right. That's right. And how do you continue to invest in that? And that's something that it's so interesting. And you're right. I think we believe that being, and part of it is what we're taught, is we believe that being risk averse in our talents is really spreading it out and diversifying like we would a portfolio. But too much diversification is dilution. Say that again. Too much diversification is dilution. We have to move in and find that sweet spot where we are focusing on, that big investment that is our strengths, shoring up where we need to. And then the other thing is we surround ourselves with a team of people that we all are able to achieve our objectives together, because we have that diverse set of strengths and weaknesses.
Right, right. Yeah. And also, I mean, for me, Christoper, as my entrepreneurial journey, I mean, I've built a few companies over the years, and it's kind of interesting because most entrepreneurs goes through this transformation where their first business is, building something out of what you already know, maybe your existing relationships you have, or your expertise, right? In your case, Salesforce expertise, right? Whatever that really is. We build these things based upon what we know and what we can leverage. But as you actually get, more insights into your strengths and what you do well, your next business is like building something that's even greater, right? Because you are getting better at your strengths, and you're building a team to people who can complement, right?
That's
Those
right.
other areas where your weakness, and then the strength of the team is so much more powerful. And
Mm,
ultimately, what I find too that I think is just really underrated is it's all about fulfillment, right? And
yes.
passion in doing, getting up
Yeah.
every day and being super fired up about, the business that you're running, right?
It really does. And it's interesting how that unfolds over time. And I do also think, you know, and I had this conversation earlier this week where somebody was talking about, well, pursuing your passion. And, my story is that when I was in college, my passion was software engineering. I thought I really wanted to be a software engineer. And when I got to this, I got accepted to this great internship. And that whole summer, I was, bored out of my mind. I didn't find the fulfillment out of it because I needed more interaction with people. I was just by myself too much. And this was where I ended up in a recruiting center, found, this alum who worked for Accenture and has said, hey, you can solve difficult technical problems with people, advanced businesses, and how I ultimately found that. And the reason that I bring that up, and I think it's poignant to what you said, is that we find our passion as we're developing our skills. And so I did focus on how do I build my skills and how do I get the joy out of the skill and the work. And then now it is the passion, right? Now my, and this came while I was building, working in technology, as I realized that my passion was really around building teams that solve big problems, not just on the technology itself. Like I really enjoy building the teams. And now, I think like you and I, now we found this passion for financial education. And we understand that, so many people, even high net worth individuals, and I know a lot of them don't understand how to leverage the equity, the money that they're making to secure financial independence and financial freedom. There's a huge chasm of knowledge. And I do get excited every day to continue to walk and talk about this journey to help people out.
100%, Christopher. And I think part of the reason is because the education is just so lacking, in academia, traditional academia, right? Nowhere is it taught how to actually protect and
Mm,
multiply your money. All we're really learning about is a particular expertise, right, within a certain domain or a certain
mm,
topic. So we learn how to make money. And I think most people are good at that, but people just don't understand the
mm,
concept of how can you multiply and grow your money as well as protect, right? Because it's also about capital preservation, right? So,
mm.
what are we doing, to do that? And you're right. I mean, we have many entrepreneurs who've had 8-figure exits, right? And a lot of folks, but it hasn't been taught to them anywhere. And frankly, people have been busy between raising families and building companies. So where do you find, the time to actually, learn these types of topics?
But and the other thing I think is important to add is that you're right. There's a lack of education, and then there's this big machine that also has these different messages for us. Right? There's this big machine, which is what I call the fast food wealth management industry. Because it's not all different. The message is really the same as this is really complicated. You can't do this. Give it to us. We're going to take your money. We're going to put it in this mutual fund and we're going to charge you 2%. And it's really not about whether you succeed or not. It's about our control. And when you have those messages everywhere, and we hear it, as we are onboarding investors, you hear all the time, well, I've heard from my wealth manager that this is risky. And of
Right.
course, you're going to hear that from him. But then when you break through, and this is, what we're talking on this podcast, like the strategies of the ultra wealthy, they're beyond that. Like when you look at, and one of the reports that I look at is you can go to Tiger 21, which is those private groups of people who have a net worth of $10 million or more. And you can look at their asset allocation. Generally speaking, the stock market takes, I would say a quarter of their allocation. And half of their allocation is divided between private equity and real estate. And it's exactly because of what you said. It's because of the fact that they're focused on capital preservation. None of those people are applying the 4% rule. They're not just draining all of their earnings and they're not taking their account down to zero and hoping that they have enough for retire. Those are the people that have bought into the fast food wealth management industry. What they're doing is they're in assets that will preserve capital and continue to give them, income or dividends or checks, or they're actually buying businesses, and also depreciation so that they're paying less taxes. And this is, to me, is where I'm excited about podcasts like this, where you're really focused on this education of the ultra wealthy and how do we break through this noise? How do we get better educated and then break through the noise of these larger industries that are trying to scare us into letting them have control of our assets? But really, the thing that just singes me, Dave, is this whole concept of when the bond market broke and there used to be this strategy of, okay, have 50% of your money in bonds that would preserve capital and send you income. All of a sudden they invented this 4% rule that I would argue is robbing future generations of wealth.
Well, absolutely. You said it so well, Christoper, right? And it is a machine, right? Because the government and all of these, top fortune companies want you to put your money in a 401k, because think about it from their perspective. The government knows that you're deferring taxes, right? Till your later years, taxes are likely going to be going up, and they can predict that income stream. And they're even telling you how much you have to take out in a given year. So they know what the revenue is going to look like in the future. But don't you want to be on the right side of that equation, right? Instead of someone else telling you what you can do with your money. So I think a lot of this is also around getting control back, right? From corporate America, from Wall Street, getting control back for ourselves so you can, make the right decisions is key.
Well, you're right. And this to me is a core strategy of the ultra wealthy is they see themselves as the managers of their wealth, and they're putting together teams that execute their strategies. And this is something that, I communicate to my investors, and, is why you have this podcast, right? Is to teach people that we need to be our own managers. And if somebody is taking a fee, we're clear on what the fee is for. And we're making sure that that fee then doesn't come with a lot of fear and doesn't come with a lot of control, and quite arguably come with low value. Because I argue, or not argue, but I support the thesis that what fast food wealth managers do, you can get from robo advisors for, quarter of the cost.
100%. Whether the market's going up or down, they're still making, fees on assets under management, and that's their business model. And fundamentally, it's incorrect, right? Because they don't have alignment of your interests, right? It's really alignment of their own interests. And I know, plenty of them, and they're all just, they're building businesses themselves, and it's all just based on assets under management. So we do have to break the mold. And just going back to what you had talked about earlier, Chris, like you really hit the nail on the head. And this is why, like, we've actually created this comprehensive wealth strategy. And the first phase of it, it's all about actually mindset. Right? Because how many people have you talked to, or do we know out there who you talk to them about investing in real estate, and you're right, they say, well, that's risky, or that's an alternative asset class, right? That's what my advisor is saying. This is alternative. But last time I checked, real estate is probably one of the oldest, industries around, right? In history, right? They call it alternative because they can't actually sell it to you. That's why it's alternative to them. But you have to start with having the right mindset where you can be open-minded and creative to learn and take in these new ideas. And let's challenge what they're saying. I started my journey by challenging what they're saying and say, look, the traditional approach all the time was the market's going to go up and it's going to go down. But you have to look at it over the long haul and say, you're going to make 7% over the long haul. Right. And,
right?
every one of them, I mean, I went through several of them, and every one of them told me that. But being kind of a problem solver, I just couldn't agree with that logic. And I knew that there was a different way of how to solve that. What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yes. And I think for myself, it was, I read Robert Kiyosaki and understood conceptually and could see it, right? I mean, I would always walk around and think, who owns this building? Somebody owns this building. Somebody is getting the benefit of all these rent checks, and it was really that, there does in the mindset, and I would argue in the mindset of the ultra wealthy, they're going to be able to look beyond the hype. They're going to look beyond, what are messages that are sent to everybody and say, okay, what do I need to do to achieve the outcome that I want? And that was truly what got me on my real estate journey, is I realized people are owning and buying real estate. They're getting all of the benefits from it. And so how can I do that as well? And that was, while living in the Bay Area in a very high cost of living area, but I was able to then look and see, oh, there's opportunities for crowdfunding. Oh, there's opportunities for syndication. Oh, there's all sorts of different avenues that I could take. And then it was really then the move to Texas that allowed us to really see and feel all the real estate here. And I mean, at that point, it was, there was no looking back.
Sure. Christoper, tell us a little bit about your personal wealth strategy. What does that look like?
Well, my personal wealth strategy is I really take that Tiger 21, sort of vision to heart, where my personal wealth strategy is really, I want to have half my portfolio in income. And when I say income, I want it something that is 7% or more cash on cash return. And I don't want that delivered in the future. I want those checks coming in monthly or quarterly. And so that's very important to me, because I believe that, having income in your portfolio today, not waiting to create it. I've realized this as we've been deploying, over the last few years, hundreds of thousands of dollars into real estate, getting out of equity. It's really important to have that income, because that's always going to be a backstop to your portfolio and give you options. The other half I then have in growth. And some of that growth can be real estate. It can be some, funds where you're actually, not going to be getting, monthly or quarterly checks, but you're actually just getting it when the buildings exit or, construction. And then I'm also still in the market, and I also do, participate in some venture investing as well. But that's my real broad strategy. And then I just try to make sure that on each side of that growth and income that I have, diversification, but not dilution. I want to make sure that I am able to get the impact of whether it's the companies I'm owning in the stock market or the investments that I'm owning on the real estate side.
Yeah, that makes sense. And that's a great point about diversification, because again, coming from that, financial planner perspective, they talk about diversification. What diversification means for them is to, have a mix between, equities and bonds, and then what's your risk profile, and kind of looking at, just having this broad matrix, which, ultimately doesn't really get you that far, right? It's all about having focus. And if you do look at that chart, right, from the ultra high net worth, they're focusing actually in domains and industries that they know and they understand. Yeah. They can actually control choke points potentially. They have inside knowledge. So as you focus in that industry and then diversify within that,
that's right.
That's how you actually diversify with focus.
It really is. And that's, I think, is a good advanced strategy for people to really start embracing, right? And I mean, as you get into, real estate, and let's say you pick an asset class, whether that's multifamily, self-storage, mobile homes, you're going to want to diversify geographically. You may want to diversify across different operators and the way that they operate. But then it's really understanding the nature of that and then thinking about how you can, blend into some other asset classes as well. I think that, that's really what I try to educate my investors on, coming out of the gate is, how do you create a little bit of a blend that's going to, again, diversify, but not dilute.
Right. Christoper, can you tell us a little bit about the asset class of mobile home parks, right?
Sure.
We have not had any guests on, going into this in detail. So tell us about the demand, the current market conditions, and, what's your perspective?
So yeah, I've had a journey over the last couple of years of really investing heavily in multifamily, where we started back in 2015, and then we started Wealthward Capital 5 years ago, 2017, and we started partnering with other people investing in multifamily here in Central Texas. It goes back to my focus on income. I think that we need high income in our portfolios, and so mobile home parks became interesting to me because very similar to self-storage is that they had higher cash flow. And the reason that they have higher cash flow, and it's very similar to self-storage, is because they have lower operating costs. So if you think about operating expenses for multifamily can be, 50%, and then you have debt on top of that. So the margins are going to be really thin of what you can get off, of what you can cash flow from. Mobile home parks generally have a 35% operating expense line, and that's a conservative one. You can operate parks down into the high 20s if you have very efficient operations. So this means that just in the nature of mobile home parks, they're made to cash flow. You generally have a tenant base that is going to be there for 10 years or longer. And so, that long-term tenant base, if you have good operations, that is going to then be made for cash flow. When you talk about the demand, mobile home parks are scarce, right? Scarcity, meaning in the economic sense, is that there's high demand and there's low supply, and they're literally, only building a fraction of a percent. Part of this is due to a lot of municipalities don't want to actually physically see them, not in my backyard. And also they get better tax treatment, or they get better tax income from multifamily versus a mobile home park, where you're not going to get as much tax, but you may actually have more demand on services, right? On your, fire, medical, et cetera. And so they're not building them, and they're actually tearing them down as well. We're seeing in some of our communities that, they're removing mobile home parks just because they're building a Class A building right in front of it and they don't want to look at it. But the scarcity works in the favor of investors, because when you get these assets right now, because of the incredible demand, that there's a lack of affordable housing. And then you also have the silver tsunami, a lot of people retiring, 50% do not have any savings, right? So they're going to be living off fixed incomes. And so this is where mobile home parks really fit into that portfolio. But this is why, as an asset class, we're investing heavily right now, because we see this scarcity and we see this, high demand for this asset, and then the high cash flow.
Right. And how does that compare from a depreciation standpoint to multifamily?
Depreciation is pretty on par, especially if you're doing some CapEx, right? You can get a cost segregation study, and, people are generally surprised at the amount. I mean, again, I'm not a tax, person, but we have definitely been seeing, first year depreciation from our mobile home parks in the, 60 to 80%, returned in depreciation. So with a good cost seg study, and then some of it trailing out over time. So it's significant.
Right. And what are they able to depreciate on that cost seg study in a mobile home park, right? What are the physical assets they're looking at?
Well, the physical assets they're looking at, generally speaking, all of the, the paving, anything that is, underground. You think about all of the infrastructure that we have to support there. Those are some of the key components. And then we'll also have buildings and structures on there that are not part of the mobile home parks themselves, so there's a lot of those different pieces. And then obviously, if you're doing some CapEx that year, you may have the opportunity for some bonus depreciation for the investment that you've provided.
Yeah. Makes sense. And can you tell us a little bit about the market as well? I know it's a bit of a bifurcated market. You've got some big players kind of coming in, trying to, buy assets up. There's a lot of mom and pop operators.
Yeah, so the market is very interesting because uh, it's still a very immature market, right? And this is where we're seeing opportunity. But even in the way that they classify mobile home parks, there's no standard, right? They don't have class A, class B, class C. They have the star designation: 5-star, 4-star, 3-star, 2-star, 1-star. And that was literally created by a gentleman in the 50s who just went around and was noting some things and created this thing. It was more of a marketing mechanism than it truly is a standard. But what you're finding is that, to use that classification, 5-star parks that are retirement communities that are 100 pads or more are really trading at very low cap rates, very desirable, because again, they have all of the traits of mobile home parks, where they're high cash flow, low operational overhead, and you have a really safe and secure tenant base, because generally speaking, these are going to be retirees that have set themselves up well to do, or they're going to be just really nice looking parks. Then you have, you start going down the stars: 4-star, 3-star, 2-star. Again, if you have a 4-star, 3-star, 100 pads and above, there's going to be some competition for that, because you can have larger players can come in on a national level and they can purchase those. What you're not seeing, and where we're finding a lot of opportunity with our Thrive Community Fund, is when you look at, lower 4-star, 3-star parks that are less than 100 pads, there's a lot of inefficiencies there, a lot of mom and pop operators that don't have a lot of debt, run it as a cash business, meaning they, are collecting cash, or maybe they don't deposit all the cash they collect. And they're also then operating it to the amount of cash they collect. So they could have a great park, they're running it at 60% occupancy because they're tired of dealing with people. This is where there's a lot of opportunity to go in there and to make some changes and to really turn these parks around.
And what do you typically do for that, right? I think everyone's familiar with multifamily value add and, the opportunities that you can do. But what are some of the typical things you would do with a park?
Number one, basic landscaping, right? Because again, like when you think about where you want to be as a mobile home park operator, you really want to be sort of a glorified HOA. And so really getting in there and doing landscaping and just some paving and things, that's really easy. Then with the homes, a lot of these homes, have these great steel frames. And so going in and doing exterior rehab and getting the homes on the outside to look very nice is not really hard. And to be able to, they have this technology called Cool Coat, where you're able to actually seal the roofs, get rid of all these rusty roofs, put a nice standard color on them. And then it also insulates from the heat and insulates from, moisture. You can go and get and that can be for, $1,500, $2,000 a door. You can actually have the exterior looking very nice, which we like to go into our parks and we want to landscape, touch the exteriors of all of them, so they all of a sudden get a very nice look and feel to them. Then the rest is operations. Our focus is on physical safety, right? We have, and we take over parks that are the majority park-owned homes. While that's not our long-term model, we want to get to tenant-owned homes. When it's a park-owned home, and they're on month-to-month lease, we can then go to, the tenants that may not have been screened, that aren't deciding to abide by park rules or the laws, and we can put them on not to renew, and we can start changing the community itself by making sure that we're managing to rules, regulations, and physical safety, that with, this nice sort of physical appearance, we can turn around in 90 days. We can have, we've had, tenants come and tell us, like, I never thought that it could be like this. Like I'm now living somewhere that I'm proud to live. It feels safe. My kids are playing in the yard again, and I'm seeing tremendous value out of this. And that's exactly what we're trying to do, is partner with our tenants to create a safe, nice community that they feel proud to live in.
Yeah, that's great. I really think of that as impact investing, and we're trying to impact, not only the lives of our investors that we can help, build wealth with together on this journey, right? But we can also help our communities as well that we're investing in to make their lives better.
And that's exactly how we see it, Dave, is that, this is an opportunity for us to, it's a win-win-win because, we, our property management team is a veteran owned business, and we're, hiring veterans into that. So we see it as taking care of our tenants, taking care of our veterans, and then delivering great returns to our investors. This is exactly, how we want to continue to grow this business.
Right. And are there any typical MSAs that you guys are focused on?
Right now, we're primarily focused in North Carolina, and so we've anchored our project out of Fayetteville, North Carolina, which is home to Fort Bragg and Pope Army Air Base. It also has some other employers there as well, and then we're expanding into North Carolina, and then we're looking throughout the Southeast. Because our strategy is really focused on buying smaller parks in areas where there's a lot of density. So we chose Fayetteville because in a MSA of 500,000 people, there's 400 mobile home parks. 100 of those meet the criteria of the institutional players of 100 pads and above. And then you have 300 parks that aren't on their radar at all. And so that's our goal, is to go and get those parks under management and then managing it as a portfolio in the city. And we're on target right now. We will have been operating there a little over a year in August, and we should have 1,000 pads under management.
Great. That's great,
Yeah.
Chris. In terms of when you look at things from the acquisition side, in this current climate, right? Are you having any headwinds, or how has acquisitions been going for you?
We're not. I mean, quite honestly, I think the current environment has potentially accelerated some of these mom and pop investors to say, okay, we're ready to cash out. Maybe they thought that they were going to hold on and get some big cash payday. We're now, a few things are working in our favor. Number one is our brand and what we're doing with the parks, because many of these owners have owned these parks for 30 or 40 years, and they see it as a legacy, and they want to see something done well with the park. They may know a lot of the tenants. They want it given into good hands. And then they're also looking for people that will partner with them. We're actually doing, we've done 3/4 of our transactions have been through seller-owned financing. And a lot of this is because of, again, they're running a cash business. They are very appreciative for us to have, a minimum of 2 years to be able to get, their financial act in order. And we usually negotiate, 5-year terms, but we can exit after, 2 years. And, the terms tend to be very favorable for us, a lot less fees for us to take over, but we're very much seeing a healthy acquisitions pipeline in this environment.
Great.
Yeah.
Christoper, if you could give just one piece of advice to our listeners about accelerating their wealth journeys, what would it be?
I would say it's really focus on income in your portfolio. I think the one thing that has allowed me to sleep well at night, that has given me a peace of mind in a down market, has been having a broad exposure in my portfolio to real estate. That's the asset that I chose, the broad asset, right? And it's diversified, but knowing that I have significant checks coming in every month and every quarter, even when I'm seeing the market beaten down, it gives me a peace of mind. And I also know that this is a strategy to accelerate growing your wealth, is being able to get this income and continue to diversify if you don't need it now. But if you also do need it, that can also help, your investment, so you don't have to liquidate some too early. So I would say focus on income in your portfolio.
Yeah, that's great. Christoper, really appreciate you coming on the show today. It's always a pleasure when we get together and share ideas. I know the audience is going to love this one. So thanks again. Any place that folks can reach out to you and connect or follow you if they want to learn more?
Yeah. So I would say, if you want to learn more about what we're doing in mobile home parks, they can go to thrivecommunity.fund. And again, that's thrivecommunity.fund. And if they want to learn more about my company, Wealthward Capital, they can go to Wealthward, 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 like moving you towards wealth. And they can check us out there. And then I'm going to be launching my own podcast soon for technology employees. Tech Careers and Money Talk, they can go sign up and get all the announcements for that as well.
Awesome. Thanks again, Christoper. Really appreciate it.
My pleasure, Dave. Thank you so much.